So, Xerox is at a massive turning point. They just dropped a Q2 earnings report that was, frankly, a disaster. And this is all happening while they're trying to pull off this huge turnaround plan called Reinvention and digest their massive acquisition of Lexmark. So the big question on everyone's mind is this reinvention going to save them, or is it just digging a deeper hole?
All right, so here's what we're going to cover. We'll kick things off with those shocking Q2 numbers. Then we'll dive into what exactly management means by their reinvention story. After that, we'll look at the huge Lexmark deal, size up the headwinds and the potential wins, and then wrap it all up with our take on what to watch for next.
Okay, let's just rip the Band-Aid off and start with the Q2 earnings. And wow, calling it a quarter to forget is probably putting it mildly. This was a big one.
Yeah, this is the number that just stopped everyone in their tracks. Wall Street was looking for a small profit, about 10 cents a share. Instead, Xerox posted a loss of 64 cents. That is a jaw-dropping miss of 740%. No way to sugarcoat that one.
And when you look at the details, it doesn't get any prettier. I mean, the revenue miss was small, sure, but that's not the real story here. The real damage was in the margins, which got squeezed pretty hard. And maybe most importantly, they burned through $30 million in cash. You know, you always want to see a company generating cash, not burning it. That's a huge red flag for investors.
So no surprise here, the stock got hammered. It dropped over 16% in pre-market trading right after the news hit. And, you know, this isn't just a one-off bad day. It's part of a really painful trend. Over the past year, Xerox stock is down 65%. I mean, look at that compared to the S&P 500 or the tech sector. It's just a world of difference.
All right, so with numbers that bad, what does management say? Well, their message on the earnings call was pretty consistent. Hey, ignore this quarter. Look at our big, long-term plan. They're calling it the reinvention.
And here's the CEO, Steve Bandrowczak, basically saying this is all part of the plan. He's framing this whole thing as a necessary, if painful, step to get the company positioned for the future. The takeaway from management is this is a marathon, not a sprint.
So what is this reinvention strategy they keep talking about? Well, it pretty much boils down to three main things. 1, make their sales and commercial side better. 2, simplify everything and cut costs. And 3, this is the big one, go out and make these huge, transformative acquisitions, and obviously, Lexmark is front and center there. Okay, I mentioned that negative free cash flow thing earlier, and I really want to double-click on this for a second because it's so important. Think of free cash flow as the actual cash a company has left in its pocket after paying all its bills to run the business. When that number is negative, like the minus $30 million for Xerox, it means more cash is going out than coming in. It's a really critical health metric.
Now for the biggest piece of this entire reinvention puzzle. We're talking about the monster acquisition of their competitor, Lexmark. The deal just closed, and look, there's no other way to say it. Xerox is betting the farm on this.
And you can really see the scale of that bet right here. You put these two companies together, and all of a sudden you're talking about an $8.6 billion company. And what's really great for them is that about 65% of that revenue is recurring. That's the sticky, predictable income that investors absolutely love.
And it's not just about getting bigger, it's about getting more efficient. Management is promising some huge cost synergies here. That's just a fancy way of saying they can cut out redundant costs. They're so confident they've already upped their target to over $250 million in savings within just 2 years. That's a big number.
This deal also changes what Xerox sells. I mean, yeah, it's still mostly about print, but now more than 10% of their revenue is going to come from these faster-growing areas like IT and digital services. And that diversification away from the shrinking print market, well, that's a huge part of the whole turnaround story they're telling.
So, the billion-dollar question is, can they actually do it? You've got this real tug-of-war going on between some serious challenges they're facing right now, and the huge potential wins if their plan works.
All right, let's talk about the bad stuff first. And the headwinds are pretty significant. You've got tariffs hitting their bottom line for tens of millions of dollars. The core print market is weak right now. And maybe the biggest risk of all, trying to integrate a company as big as Lexmark without messing it up. Oh, and they also have a ton more debt on the books now.
But on the flip side, the potential upsides, the catalysts, are just as powerful. If they can actually hit that $250 million synergy number, that's huge. They have this massive new customer base from Lexmark that they can now sell their high-margin IT services to, and they've made it crystal clear that paying down their debt is priority number 1.
And I gotta stress this again. Management is playing the long game here. This isn't a quick fix. When you look at their timeline, you see that the real financial benefits, the big savings they're targeting, aren't expected to really show up for another 2, maybe even 3 years. This requires a lot of patience.
Okay, so we've weighed the ugly short-term picture against the ambitious long-term plan. So what's our call here at Talk Tickers? If you look at the company's own guidance for the rest of the year, it really tells the story. That revenue growth of 16 to 17%, it looks fantastic on the surface, but remember, that's almost entirely just from adding Lexmark's revenue. It's not organic growth. And meanwhile, the metrics that really show the health of the business, margins and cash flow, are still under a lot of pressure.
So, after running all the numbers and weighing the pros and cons, we're officially assigning a market perform rating to Xerox.
And here's why. Look, the strategy, the logic behind what they're trying to do, it makes sense, it's sound, but the execution risk right now is just massive. Between the tariffs, the sheer difficulty of the Lexmark integration, and the weak macro environment, the challenges are just too big to ignore. So for us, it feels like the risk and the potential reward are pretty evenly balanced right now.
Which really leaves us with the one critical question for anyone looking at this company. Management is asking the market for a lot of patience. They're selling a long-term story. But with the short-term risks this high, can that story really win investors back?
This is not financial advice.